Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at axontire.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit axontire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast 219. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years, and TractorZoom, delivering insights. This week, I've got Rich Posson back on, and I love having Rich on here because Rich is kind enough to come on and give me his kind of 2 cents on what's happened with the economy. So Rich has kind of been a mainstay of the Moving Iron Podcast for a while, and kind of bounce in and out here with each other when we're not too busy to get hooked up with each other. But for the most part, Rich and I have had a pretty good relationship here over the last couple of years, and talking about what's going on in the marketplace. So Rich, how you been, man?
Good. And yourself?
Not too bad, but it's been busy. And there's just a lot of irons in the fire right now for, I think, about anybody anywhere buying or selling anything right now. There's about a million different things going on, it feels like.
Yeah, I've even added real estate brokering and investing. Well, I've always been an investor on and off in real estate, and so I've been running more than I'm used to. And I've been out there watching what people are paying, and it is unbelievable. I'm seeing rural homes where they have doubled their asking price, and it's just crazy. And it's amazing. Some people are paying these prices, but it also feels like maybe the buyer is saying, wait a minute here, I really should try a lower price. I mean, it's just amazing. The past 2 months, people would pay the asking price or more, and they wouldn't do home inspections. And we also work in farms, and the farms, nobody seems to use home inspections anyways. But the farms look pretty strong too. It's just. But I think, at least on that home sign, that was hotter than the farms. And it just feels like the buyers are starting to say, instead of chase. It was just this fear that someone was going to beat them. And it was a rightful fear. I mean, we just sold a home here last week. And if they didn't pay $5,000 more than the asking price, they would have missed it. Yeah. So, but that's, you see these surges at times, and I think it's going to calm down.
Right. Yep.
And then you take a look at the home cost. Building a home, unbelievable. I mean, some of these places running 60% more in cost. I think I've called a long-term top in lumber, and I've been in conversations with people working at some lumber mills locally, and they claim they got all the logs and all the lumber you want. It's just not moving or hasn't been moving. But I think that's going to break loose.
Yeah. Well, I've seen the pictures of stuff out there with piles of lumber sticking up all around railheads and those kind of things. So, seems like there's a lot of that going on. But, Rich, you have a lot of good stuff going too, where you have a podcast. So talk about your podcast, where they can find that podcast, and what kind of information you're going to get.
Sure.
When they listen to your podcast.
So the podcast, you can find it at criticalpoint.podbean.com. And the name of the show is Critical Point, and it really just offers signals and analysis for my models, some discussion. I don't have guests on it. It's really just a method of saying, hey, here's my opinion, but here's my model's opinion as well. Am I with it? Do I have something else to offer? And I primarily focus on the three major grains: corn, wheat, soybeans, and the stock market. But there's a very strong secondary forecast of the economy, dollar, gold, Bitcoin, interest rates, especially the interest rates these days, along with inflation. Do get into some climate forecasting where I'm looking for crop risk. So a lot of other things I throw in. Some of those things are free, but when it gets right down to signals in those primary markets, where I think I've had a track record that I've built now for 20 years, and I think it's an impressive one, well, then that's when I ask to be paid for it. And I think it's a very competitive price for something that gives you signals. And that's $27.99. And they can find it at criticalpoint.podbean.com. And if they ever want to chat with me, I'm at Rich_Posson on Twitter. So check that out.
Yeah, good information too that it puts out. So check out all those places. My feeble mind understands what's going on there, so I'm sure everybody else's will too. So check out Rich's stuff. A lot of great information there. All right. The reason I wanted to have Rich on here is, we've heard all kinds of inflation talk, right? We've heard, you listen to the private sector people talk, inflation is going to engulf everything and it's going to be the worst day ever. Listen to the Fed, they're like, yeah, but it's not, this inflation thing, there's going to be inflation. But yeah, it's going to be that bad. And then, the week before that, they were like, I've never even heard of inflation, and we're not really I don't know what you guys are talking about. So there's been some kind of talking out of both sides of their mouth when it comes from direction we hear from the Fed. So, Rich, the biggest question that's kind of been kicking around in my mind a little bit, we kind of talked about this a little bit before we started recording, but when I look at the GDP numbers that the government's throwing around and these inflationary things that we see popping up and those kind of things, how much of that is a direct correlator back to, all right, so we've had this recessed economy, kind of a self brought on type recessed economy based on trying to keep everyone closed down and the COVID thing kind of control as much as we can. And now we're kind of coming out of that. The economy's coming back to life. We're pumping more gasoline out there. All these different things, or just people are out moving around doing a lot more stuff than they had. So wouldn't you naturally have a pretty big jump in GDP just because of that? And then secondly, wouldn't you naturally see some inflationary things because of that as well?
Yes. And yes. What occurs when you go into a recession, prices normally fall. And as soon as that recession's over, if it's a fast recovery, prices will catch up to where they were and then some. And if you calculate it on a percentage basis, comparing to that prior year when it was recession and lower price, you're automatically going to get a high inflation number. And it may not actually feel like it's that high. And it's just how the math flows. It will balance out eventually. It'll smooth out. And you see the same thing sometimes in GDP. Suddenly you'll get a massive jump in GDP. And then one of my favorite indicators is the PMI that comes out every month. And you'll see the same thing. It'll crash during a recession, and then it just explodes and looks so incredibly strong for the next few years. And then when the economy's doing really well, the PMI is actually going down. And it's not saying there's a bad economy at all. It's just how the math flows. It's still signaling a strong economy. I think that's what we're seeing now, that with this whole COVID virus recession, we got something far more serious than a normal recession that we get every decade. And we really pumped the money. We really put the brakes on to help support that economy. And it also kept the inflation from just collapsing as well. But the point is, as we come out of that, it helped give us that kickstart, that jump in inflation. And to give you an example, if I can pull up my spreadsheet here, around 1950, inflation pulled back to less than 1%. The economy was not necessarily doing that good. The GDP was backing off. And then in 1951, inflation jumped to 7.89% 1 year. And it looks like to me we're kind of doing something similar like that. We're going to get a high inflation number this year. I think that's guaranteed. It's just a question of what is high, how high, those kind of questions. But we're going to see that surge. We've seen it already in just recent reports. It actually upset the stock market a little bit, the day of the report, that is, and then they got over it. But the fascinating thing is that in the 1950s, if you look at from 1951 and on, inflation just calmed down. It dropped from 7.89 to 2.19 the next year, and then was basically back to 1%. For the entire 1950s, it averaged 2.1%. 1960s averaged 2.4%, and you still had a few explosions there coming out of a recession in the 1960s. It wasn't until the 1970s that you see an entire decade average 7.1%. So inflation was just running hot, okay? Because if you think about it, if inflation is going to run like 2.5%, that means your prices are up like 25% or more within a decade. Well, my gosh, you then go to 1970s and you look at 7% inflation for an entire decade. I mean, prices more than doubled during that decade. And that's the pattern I want people to think about. There's such a thing called the inflation cycle. And the inflation cycle, in my opinion, if we looked at the most recent one, it ran as inflation from 1950s into 1970s. And then from about 1980 on into literally as of last year, we were in disinflation. That's the other side of that cycle in order to complete the circle, right? And so we've gone through that many years of disinflation, which is not necessarily lowering prices. It just means prices don't rise as fast as they did during the inflation cycle. But the thing is, inside of the inflation cycle and the inflation phase, you have what's called early inflation, then late inflation. Early inflation is the larger number of years during inflation, and it's generally good. People see their paychecks rising. They look at their stock account saying, hey, I'm making a little money there. They look over in their savings account saying, hey, my interest rate's rising a little bit. They look at their home saying, wow, that's going up as well. And they're rather happy. Over time, however, we kind of mess it all up, okay? We break the machine. And part of the reason is everybody starts hollering, well, I need a pay raise just because my grocery costs are going up. And so it's not linked to how we really should be doing business in the economy. And we get into late inflation that can lead to runaway inflation, and that's bad. That's what occurred in the 1970s. So my guess is we're just starting this cycle. I don't think we're on a situation here that's leading us into late inflation right now. I mean, it just does not make economic sense at this point. So yes, there's a reason people are scared right now of high inflation this year because it's large, it's been fast. But my guess is things are going to calm down during the rest of this decade. We're probably not going as low inflation as what we've seen in recent years, but it's not going to be this runaway inflation. I think that's next decade. It might even wait to the following. But I'm willing to say this time around, the cycle will be a little shorter. So we may see that late inflation next decade where that could get out of hand. But right today, I'm viewing this as rather constructive, but it's different than what we've been used to over the last 20 to 40 years here. And we're going to have to make some adjustments how we do business. Things are going to cost more, but it's not necessarily a sign of a poor economy. In fact, GDP runs a pretty good, runs a fairly strong positive correlation to inflation. If inflation's higher, then the GDP is going to be higher, but people will say, well, that's a better economy. Well, the problem is the economy can get too good and the GDP can get too high for too long. And now you have an overheating economy. That's when that inflation is now going to start speeding up when it already was moving higher, but it's going to speed up at a faster pace. Now you got a problem. And I don't see that for a while yet. I think the Fed has been thinking, they used the term transitory inflation in recent months. And that says that they think, sure, you're going to get scared. You're going to see an explosion of inflation. It's just going to back off. Now they're saying a little less of that. And the reason is they just want to acknowledge that we're in that phase that's strong. I think if we could speak to them privately in their office, they'd say it's going to be transitory. This will back off and we're going to be all right.
All right. So when you look at you talked about, the next decade, you thought there could be some runaway inflation and those kind of things. What are some of the indicators that we should be looking for when we start looking at that, that inflationary kind of boom that you're talking about?
As far as like getting into a runaway phase, or just what we think? Yeah, I think what you would have to consider is inflation stays 3 to 4, 5, 6% for like 3 or 4 years straight, consecutive years. Then that's too long. That's too long of a trend. And you're also going to see the bankers or anybody loaning money to anybody is going to be rapidly raising interest rates. But to have a spike in inflation this year, we are seeing it, and there's more to come. That is not enough to say you've launched one of those late inflation kind of trends and got a serious problem. That's for the moment, that is typical coming out of a recession. It's typical of launching a nice economic growth pattern within early inflation.
Okay, so usually with inflation, we start talking about interest rate costs, and any, in the agricultural business, most of the guys that are out buying equipment right now have a very fond memory of what inflation was like in the 1980s. So, and interest rates on top of that. So as we come through this kind of inflationary kind of ramp up coming out of this recession that we're in, what are your thoughts about the Fed raising the interest rates from 0 to 1 or 2%?
Well, 1 or 2% does not scare me, because that's probably what they need to do, and they will do eventually. Okay. Problem is, though, depends how interest rates affect you, what kind of business you're in. If you're into banking or investing in debt, you've got, for some reason, you borrowed a bunch of money and never locked it in, and it's long-term money. I fully understand not locking in short-term because you think you're going to pay it off in a short period of time. But boy, long-term, these are not the days anymore to be gambling, to not be locked in. Like if I got a 20-year mortgage on a home, I want to locked in these days. I just don't want to gamble and try to figure out how do I deal with it if it does go wrong. So the more sensitive you are for interest rates, you could make an argument that I just said, going from 0 to 1 or 2% means nothing to me. For some people, they say, what are you talking about? That's a doubling, tripling of my interest cost. And there's no question about it. That's going to shake some people. At 2% is as scary as 8% was, 15, 20 years ago, Right. So we do have those issues. And, even though I'm trying to put down some Wall Streeters are worried over that, I have to be cautious because it can impact some. But to me, going back to 1 or 2%, that's the correct thing to do. I think you actually balance things better and have a better economy. And it was interesting. Treasury Secretary Janet Yellen, who had been the chairperson at the Fed previously, was out this week and even made comments. Well, higher interest rates are not necessarily a bad thing. It could even be a good thing. And everybody knows that Yellen is basically willing to allow higher inflation, higher interest rates. And it's fascinating to me because when I came up with this inflation cycle idea and then applied it to my cyclical models in business, and I said, you know what? That cycle is going to turn, and I had pretty much pegged it about the right time to turn. I kept thinking, well, are we really going to see the Fed and Treasury and government talk with that kind of attitude? Because they've been on this thing for 40 years now of lower interest rates. Well, it is interesting. The Fed and Treasury are talking like that. And the Fed had been actually talking in the past few years. Treasury had been quiet on that. But now you've got somebody that was in the Fed and the Treasury and they're no longer quiet about it. So, which is also something interesting. We haven't seen the Treasury and Fed actually be able to have such a strong connection. It'll be just interesting what does come down the line here of what do they want to try in terms of policy. And some people feel like, I don't know if I can explain this definition, but they feel like you have monetary policies, which is really what we've been working on for 40 years now. And then you have fiscal policy. And they claim the fiscal policy is what's going to lead to higher inflation, higher interest rates. But they even say there's periods of time that's not a bad thing. That can be a good thing. And they're also saying, well, fiscal policy was really where we were from World War II on into the 60s. And I thought, wow, maybe I don't have all the academic details here, but you folks just told me what I've been thinking from my own model research and these cycles, that it is time to do it. I think we've got the people in place that if they don't create it, they're going to allow it. And so bottom line is, yeah, inflation is going higher, whether you like it or not. You got to learn how to deal with it. But to panic and say, oh, we got to have a political movement to stop all this or something, it just does not add up to me. It would have to be something new I haven't seen in 200 years worth of history. And anything new can happen. It does eventually, but it looks like we're doing what we would normally do for this phase of the cycle. And I think we're going to have a growing economy. And I think people are going to do well, actually, and the markets are going to do well, but we're also going to have a bit higher interest rate cost and a little bit higher inflation. So.
Okay, so along this kind of same inflationary theme that we're kind of have here right now, you start out the podcast talking about real estate costs and lumber costs and those kind of things and what that looks like and how those things are working together and those kind of things. So I've been given this real estate thing some thought for a while and looking at new housing starts, and it kind of seems like new housing starts have kind of fallen off a little bit, but not as much as you think they would with the price of materials the way they are right now. So what's your thoughts on the overall economy when it comes to just what it costs now to get lumber and rubber and iron and steel and all these different things to go out and build, whether it's cars or houses? Talk about that a little bit and how you see that affecting the economy over the next couple of years.
Yeah. The other thing about our economy is, like, if you see something swinging in a certain direction, you'll find some people being hurt by it and some people are actually benefiting. And we've gone through this phase in the past 20, 30, 40 years, and it was clear we were benefiting certain groups of people, certain industries, and now we're just swinging other ways. So some people are actually going to make some money out of this. But there's no question when you look at housing, on the other hand, that's extreme. I can't imagine having to go and get a mortgage. And I want to build a home too, but I'm doing my best that I don't have to get a mortgage. And if I've got to tell you, when I look at these costs, I'm struggling. I'm trying to find alternative building materials. And I already planned on building a very small house now that our daughter's moved out and this and that. And I just said, hey, let's experiment with something really small, really modern, have some fun with it, and keep our costs low. And wouldn't you know it, I get all set up and ready to do it. And then we get hit with this, and my costs for my little house are more like what I had for a large house, And it's like, that has to come down. I don't see wages going up enough where people would say, well, yeah, it cost me a lot more, but I can do it. I want it. So we are doing it. That's going to back off, especially when that lumber breaks through, gets through the supply chain, and it will. We'll see it come down. Now, the question is, it went up so fast. I'm thinking, yeah, but the price is probably going to go down slower than we'd really like. It's probably going to take a few years. And since we are embarking on a brand new inflation trend that's more than just a few years, it's a couple of decades or more, you could make an argument those prices are never coming back to the worst price we've seen over the last few years. So I can't even think what that price was on lumber. I could probably look it up quick enough. But at the same time, this is just an astronomical price. I mean, I was used to $200, $300, $400 lumber futures, and we've had $1,600 lumber futures or something like that,
Yeah.
So it's coming down. It's coming down a huge amount, but I don't think it's coming back to $200 to $300, $400 this decade, maybe not even next decade. So we have changed. This is an historical moment, just as I always felt like President Reagan come in and it was a massive change. Well, regardless of what you think of Biden or even what Biden's thinking of what's going on, this is some kind of symbolic thing of a change here. I'm not really trying to talk politics. I'm saying this is a change of how we're going to do business. It is big, but it's not bad. At least not now. But these high price things that are bad, they are going to correct. It's amazing how quickly we can buy supply and commodities these days. And that's why I want to caution some commodity people who think, well, these prices got to go up for a very long time because this inflation is here. There was so much money printed. Well, someone over at Bloomberg even had a nice article out. I forget, it's a different site they use. Wasn't their main site. But it was well done. It showed charts of basically you raise prices really high in the grain markets. It's fascinating how quickly you buy large supplies. And so I say, hey, inflation, I say lumber's peaking this year. Okay. And I think maybe copper is peak, but copper, I'm not really that negative over the next few years. There's a whole global scenario there where they might not be able to find enough copper fast enough. And the lumber, however, I think that can be down a huge amount by next year, and I'm hoping so because I want to build my house. So I may learn I have to build a cave in a hill somewhere, but a sod house maybe. But to me, I've made the long-term call. It's my second call. I admit to it that it took me a second shot to get it, but I think I got it. And if I'm wrong, well, I'll retool it. But I think we're very close. We'll see lumber back off next year quite a bit. Maybe copper. I also think all these commodities are basically topping out this year. I am bullish into sugar. I own some sugar. I've owned it since last year, trying to hold on to next year. But I'm looking at some of these other commodities saying, you know what? I think the highest price will be seen this year, and they're coming down. So I think the commodity portion of inflation is going to be will have backed off by next year. Now the key is, can it somehow stay up until the start of next year, then come down, or does it start down this year? And I think it's starting this year. I think we're about there. We got to get through this whole summer for the grains, obviously, and see how the weather impacted and this and that. But later this year on to next year, I'm quite confident grains are coming down. Cattle could be a bit different. It doesn't have to synchronize, and I don't study the livestock as much as I used to. By the way, I'll tell you a little story. I've had someone that I've worked with for over 10 years now in markets, and they're in the hog business, they're in grains, this and that. And even though I don't study the hogs so much, I did a little work for him, custom work, and we both agreed that part of this inflation isn't just all the money printing. It isn't just trying to get out of this recession. It isn't just normal economics and then this super cycle inflation. At least for this year, you've also got the people that are back to work. They don't have to wear the mask. They don't have to stay home. And they want to party, Casey. They want to go. They want to go places. The barbecue grill is gonna go like never before, I think. And the keg, and people are just going to go, and that's going to help boost the economy. I think the economies do very well, but it is also going to keep those prices up there, and it's going to help keep the inflation up there. But I think next year's the year that's going to be the key where we should see things settle down. So let's say this year inflation comes in 4, 5, 6, maybe even as high as 7%, like it did in 1951. I just think next year you'll be back 2 or 3%, which is still stronger than what we've seen in recent years. I mean, boy, the Fed has been frustrated for 10 years now. They can't seem to get inflation over 2% so they can raise interest rates. And so, we've turned the corner. I think the Fed will see that it's now very easy to keep it over 2%. So by no means am I saying everything's getting cheaper in the next few years. Overall, this decade, everything will get more expensive. But for those of you on the commodity production side, it's fascinating how much production that can buy, and you can get squeezed when prices don't go to extremely low prices, but they're not as high as you'd really like relative to your input cost. And so you're still going to have to play that margin game the next few years, even if prices stay up better than they did in recent years. The profits may not be there as much as you would like, because these costs are here. And but again, I just think this whole, like I say, lumber's the biggest one. I don't know how anybody dares bet on the downside of lumber. It's a very illiquid market. You can get burned so fast. But to me, that's the one that ought to come down the largest amount of anything out there. And I believe it will. And somehow that's going to trickle all the way down to Lowe's and Home Depot when you go pick up your 2x4s to stud out your house. We will get a break. We will get a break. But I also don't want to tell people that, hey, no worries, prices are going all the way back to bottom. I do not see that in any of these markets either. So, but yeah, my best scenario is we're going to get a little relief on inflation next year. This is not a runaway thing where it's just super strong inflation for several years.
Right. Okay. So another question I've been trying to get my head wrapped around is, I was the same way like you. I sold my house I lived in. I got to a rental house, started going down the path of building my house, and all of a sudden our budget was the front door basically at that point. So it was, as you take a look at these houses and these inflated costs that we're seeing, which, in some cases, the typical, what used to cost you $350,000 to build now costs you, $650,000 or $700,000 to build. And now we're starting to look at kind of when this all settles down and everything kind of comes back down and we get back to a more reasonable building material cost, what's that do? I mean, are we setting ourselves up for another housing crisis because now their house isn't worth X because of when it was built? I mean, is that something to worry about? Is that something that you think about?
I will say no, but I fully understand why some people say, boy, there's a lot of people out there saying yes, we're in a housing bubble. But the best information I've seen from economists, as well as just housing industry type professionals, this is not the bubble we had in the 2000s. It was just way more speculative, way easier money when the rest of the economy really wasn't doing all that well. Well, it was doing okay, but it wasn't a robust thing. And so that was a special situation back in the 2000s for that real estate bubble. And I certainly lived through it. I mean, I watched my home double and triple and nothing flat. And then I said, what am I going to do? Because I really want to live here. And if I live here, it'll probably come all the way back down. And it did. Okay. And I remember a Florida lot right on the Gulf Coast. A relative asked me to take a look at it. And my gosh, we looked at the history and that thing went from like $30,000 to $300,000 and back to $30,000. And she bought it. So that was crazy times. This time around, you may see locations within the country where these homes back off quite a bit. Old homes, maybe home builders say, okay, I can now build this cheaper for you. But I don't see any massive crash there. In fact, I'll tell you that, and this is a tricky part when here I am working real estate, and it reminds me so much of, I think, 1998 when my wife and I bought our first home or something like that. And prices surged just like what we're seeing now. I said, what are we doing? I said, I know, because we got a recession coming in 3 or 4 years. Everything's going to fall back. But we had missed out on like 5 homes in a row trying for them. And I said, boy, if we want one, we just got to get serious, pay up for it, get it done. We did that. And our home really didn't come down at all during the recession of the early 2000s. And within, I would say, 5 to 7 years after we bought the home, it was worth more. And that's how I'm looking at this decade, is even though this has been a massive surge higher, some of these homes up, 30% to 100, 200%, I'm guessing later in the decade, we'll see those homes up like maybe 2% a year, 3%, something more gradual, something more normal. So that doesn't mean you're going to see a collapse in prices. I'm not saying you won't find a certain location, that certain home that somebody had to bail on it, but now you're talking a distress situation. You're not talking macroeconomics. You're not talking what's going on for the nation. And as a nation, I'm not saying there won't be some that come down quite a bit. My guess is looking out the end of the decade, most people are going to say, you know what? It wasn't all that bad a thing of paying that high price in 2021. I just don't know if anybody's really going to lose that bad. If they do, we'll probably hear is because their town lost some businesses and you got unemployment. It's more of a local issue, Don't know how much I can guarantee that, because obviously any home that's up 300%, 100% right now or anything, that's really getting out of hand. But for some of these homes, like building a new home at 60%, well, it's going to back off some, but over time, they'll edge higher later in the decade. Some of these homes in the $150,000, $300,000 range, again, they can back off some, but you might see them back off 10%, but that's no panic thing. And by the end of the decade, they'll probably be worth more. And I must say, looking out the next decade, I think homes over 400,000 probably are going to have a more difficult time to sell just because of the higher mortgage cost. Whereas the people under 400,000 might be better. Now, when I say that 400,000, I'm talking average places around the U.S. Obviously, if you're in San Francisco, you can't even find a house under $1 million, so that's a different ball game. But
Right.
I don't know if I explained that well enough, but I don't have enough true details and formulas, and it'd be too complicated and too long to explain it. But I just don't think that it just looks like history is repeating for what I'm doing with this modeling. And yeah, I'm not going to forecast a bursting bubble in real estate. And another way of looking at it, even if by somebody's definition that would occur, I'm going to lay $100 bet down that you will not see the economy hardly be affected by that. And real estate is, home building especially, is important to the economy. I just don't see that massive blowout we had in the 2000s. Totally different banking system, totally different loaning. We just don't have that kind of risk here. Is there risk of lower prices of a home? Yes, because we know they've run up too fast. But is there risk for someone seeing, wow, I bought this house, collapsed the next year, 10 years later, I'm still underwater? I don't see that happening unless it's, again, just a local issue. And that gets tricky in real estate when you're trying to forecast, because it is about locality. So,
right. Exactly. Yeah, that's exactly right. Okay, so here we are. We're halfway through the year. We're in month 6 of 12 here. We're kind of in that last half of the year where we start seeing some key indicators start popping up. You start looking at from the ag perspective. We got planting done, harvest is around the corner. We've got South America with their second corn crop, which is, they dropped the prospected harvest down a little bit more again. So they're not expecting hardly anything close to what they thought when they first started out. So there's some things there. When you take a look at, consumers heading into the holiday season, those kind of things, towards the tail end of the year, we got the summer grilling season and summer travel and those kind of things. As you take a look right now, which you kind of hinted at this a little bit beforehand, there's a half of the year here where basically people are just going to get out and go. So what's your thoughts here from now through the end of 21 going into 22? What are you looking at? What are you seeing? Kind of what are some of your expectations?
Yeah, I think I could see how the inputs to inflation are going to top this summer, and I think they're going to back off, but it can delay a bit. It could lag a bit. I think relative to the economy, we got higher GDP numbers coming, expectations here. I think we're going to be 4% or higher. And I'm sure some people that have been forecasting 6 to 10, and they could be disappointed. But you give me 4 or higher, I mean, there's nothing to complain about. I mean, we've been stuck with 2 and some percent GDP for several years now. And there's more economic growth to come out of this, and it's going to push that GDP higher. Probably a little wage increase there. I wonder if the wage increase won't really be next year. That can help hold up inflation. So in other words, we drop the commodities next year, but you bring up your labor, and the result is inflation doesn't come down as much as you might expect if you were looking at commodities. So labor inflation, I can see that could still take a while to get going because people are still coming back to work. It may take them a while before they say, hey, boss, need a raise, costs are going up, I got to do things. So, and not only that, people will be uncomfortable of, well, how the hell is my job doing here? And a lot of people are going to be ordered back to work from June on into September. It's almost every day now see a corporation saying, yep, we've warned our employees. They can't be working from home. They got to get back here. There'll be those kind of shifts. But ultimately, I think a lot of stuff will continue to fly off the stores here. And the good news is however, help that supply chain. So there's more stuff on the shelves that can help temper how much higher this inflation. That's why I still think we're topping this year and we'll be down some. But the point is, inflation is only one portion of the entire economy. You also have to make things, do things, consume things. You got volume. And I think the volume is really going to take off in the latter half of this year. I think these warehouses are really going to start moving stuff, and we'll get back to normal business. So anybody who's complaining of supply disruptions, I think that's going to start going away. And it'll be interesting even on the computer side with all these chips that go into our cars and go into everything else. I think it was Goldman Sachs come out today and said, you know what, during the latter half of this year, that chip thing is going to get back to normal or near it, something like that. So, the production is going to come online. The volume is going to come online latter half. I think that helps temper how much higher this inflation could go, maybe even start bringing it down. Meanwhile, people in the stores are going to say, well, yeah, it's now easier for me to buy whatever I want. And they're going to have the money for it. The jobs are going to be there. I often watch the JOLTS report, and I saw, I think it's always 2 months behind or something like that. I think it was for April, and it just showed, I think, a record high for the JOLTS now. I think that report has only been around since the mid 2000s, but that just means, the jobs are out there. They're being offered, And I realize a lot of people don't want to work, but hey, this whole unemployment thing, I think I said last year that I was willing to go along with all this unemployment, help out to about mid this year. And then if we see the economic conditions, then I would actually vote against people who want to keep writing checks, and that people just got to get back to work. Okay. We just got to get back. And you know what? I'm seeing those economic conditions. So I'm telling everybody, get back to work. So help out here and help yourself.
Right.
And I think they're going to do it. So I see good times rest of this year, other than we'll still, obviously we're going to hear people saying, boy, it still costs quite a bit to go out and eat and this and that. Well, yeah, that's here to stay too. But, people are going to do business. They're going to eat. They're going to have a good time, I think. I don't know how to forecast Christmas sales, but I think I think we have a decent shot at decent Christmas sales.
Yeah. Yep. Well, I think this is a kind of, I'm anxiously waiting to see what happens here, especially whether you're looking at used cars or used farm equipment or whatever it is, construction equipment, whatever it is, because there's such a void of the amount of new machines that are going to get built and the number of used equipment that's been taken off the market, that there's that. How long is it going to take to rebuild that used inventory of equipment, whether it's farm equipment, construction equipment, or used vehicles or something like that, to where there's not this feeding frenzy, type of mentality that if I want to get it, whatever it is, I got to go out and get it now. And if I can't get a new one, I'm going to get that used one over there that's got, low miles or low hours or whatever. So I guess as you take a look at that heavier equipment side and those more expensive things out in the marketplace where these chips have made such an impact on what's going on, what's your thoughts about that sector of the economy?
As far as like used versus new?
Yeah, like right now, like there's not a lot of used to anything, right? Campers or cars or combines, right? Now there's but there's not enough new equipment coming off the line to backfill that used appetite. You know what I'm saying? That 1-2-year-old trade cycle type thing.
Yep.
So
yep.
How long is it going to take for that to bounce out, you think?
Yeah. Like I say, I think we're going to make a real good effort on rebuilding everything here the next 6 months. But maybe in agriculture, on some of the machinery stuff, well, I would gamble by the first quarter of next year, you'll be back to normal.
Gotcha.
That makes sense. I could see agriculture maybe delaying a little more than, the autos would be under maybe have a greater capability of seizing any supply that helps them so they could produce more than some of the agriculture equipment. So I'm willing to delay it just a little longer on the agriculture equipment. But towards the end of this year on into early next, I think basically we'll be saying, hey, you know what, we're back to where we should be.
Yep. I'll tell you what, Rich, this is good stuff, and there are some guys out there that are saying that the sky's going to fall, and then there's others out there saying that it's going to be they're going to say temporarily this is going to be a rough patch, but we're gonna rebound nicely on the other side. So it's just 2019, 20, and 21 are going to be some years that we look back on and have some very unique conversations about historical things that probably won't ever happen again until the next pandemic, I guess, comes sweeping through the thing. So
I know
crazy times.
The other day, I just read something where they're still arguing over what really occurred in 2008, 2009 with the financial crisis, what kind of depression it was. And I said, gee, guys, you got to move faster than that. So it's like, it does take time. And that's why we need these discussions. So we're always learning and moving forward. But it's like I say, I fully understand some of the talk out there that scares us all. But the more I love to study history, I don't view myself as a historian. I might not even pass a story test because I'm always summarizing everything. It's that was good, that was bad. That's really what I want from history. And then I look for patterns. Okay, well, that occurred for that generation. What was the other generation that occurred? And the way we are right now, yes, inflation is, I would say it's waking up, and it's going to be around for a couple of decades where, it's been gone for 40 years really. And so it's back, but this is not like the 1970s where we say, oh my gosh, it's just every year, everything is so expensive. Big surge this year. But I think next year we'll see. We'll still see. Let's put it this way: let's say we get 5-7% inflation this year. All right. Next year, let's say it's 2 to 3. Ooh, big pullback. But what's that really saying? It's saying prices went up 2 to 3% more than they on top of the prices this year. So prices still went up. It's just inflation backed off. But the point is, at least you calm down, and that's what I'm trying to tell people. Get calmed down, and especially on the commodity production side. I don't want people thinking, well, hey, if I got $8 corn this year, I'll have $9 corn next year, and I'll have $10 corn the following year. Well, from the 1970s, I'd say, you know what? Maybe you got a chance. You look back 1950s, 1960s, no, you don't have a chance because the production is going to be there. And the only way to create it is you have a crop problem for 4 years in a row. Well, that's not inflation. That's a crop problem. Totally different scenario. So without talking the crop problems, my subscribers, they're watching me all the time now because I really do think we'll see lower grain prices next year. So the key is, should have already sold it, or you're going to get an opportunity here in July, or maybe we do have a crop problem. You get another opportunity August, September. But the point is, the way I look at it, no matter how high it goes or doesn't go, we'll see some things settle back here next year. And I do this work with commodity indexes. The Goldman Sachs Commodity Index, it's a whole basket of commodities. It is a little more leaning towards energy markets, but I really believe that index will be back down next year. The good news is, I think looking out this decade and next decade, we're going to have more upswings, those little 1 year upswings in commodities, more than we've had in the last 20 years. So there's still some encouragement to get better prices in the future here. I'm just saying, don't expect these prices to remain this high throughout next year, and do keep an eye on your input costs. So be cautious how you're spending that new found money.
Right. Exactly. Well, Rich, give the folks information one more time about where they can find your podcast, and also how to get in touch with you if they want to reach out to you.
Yeah, so you want to go to criticalpoint.podbean.com. And you'll find a list of videos and audios there. Most of them, you have to be a subscriber, and you click on them and you'll find a buy page. Some of them are free, however, especially if I'm talking long-term stuff, some of the weather, some of the economy stuff. And then if you want to chat with me, you could go to Twitter at Rich_Posson, Posson. Give me a direct message. Follow me on some of my tweets, because I also give some free ideas, as well as let people know something new just showed up on my site, and to take a look at it. And it's more than audio. You will get some videos where you could see some of the stuff I'm talking about, and it really makes a big difference. People say, oh my gosh, this is how markets work. So come on board.
Right on. Well, good stuff as usual, Rich. Thanks for making time for us to get connected. I know we've both been playing hit or miss here for the last couple of months, trying to get connected when we both had the time to do that. So thanks for being on the podcast again, man.
All right. Thank you.
All right. Well, I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you're going to find the latest editions of the Moving Iron Podcast. Also, any blogs that I've got posted will show up there as well. Go to MovingIronLLC.com for the complete library of the Moving Iron Podcast, all the blog posts I have, and also all the information for the Moving Iron Summit coming up here in Nashville, Tennessee. That's going to be September 15th through the 17th. So all the information that you need for that will be up in the navigation bar. Just click on Moving Iron Summit. You'll see all the agendas for who's going to be there speaker-wise, how to book rooms, all the how to register for the meeting, those kind of things. So make sure you check that out. Also, want to bring everybody's attention to a new podcast that I found. A couple friends of mine, Adam Werner and Greg Zerlini, both guys that I know down in Georgia, and they've got a dealership down there. And basically, it's called Agish, and it's a great podcast. They had me as a guest on there, and I highly encourage everybody to go check that out. It's kind of what's going on from their point of view, and kind of what they see happening in the marketplace. So it's well worth your time. Give it a good listen. Again, go to Agish. It's out there on iTunes and about anywhere else you can find it. They got a Facebook page as well. So check that out there at Agish, or go to agish.com, and you're going to get a great listen there, guys. It's a pretty uplifting, fun paced podcast about what's going on in the ag marketplace. You want to check that out, do that as well. So with that, I am Casey Seymour with Rich Posson. Let's give me some iron, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon, from product development through sales and service. To find more or become an Axon dealer, head over to agmarkets.com.
Moving iron in the 21st century. Hard work